Welcome back to a new video. Today we will be talking about how to make your own ETF portfolio and make $1 million with it by just investing $300 over the next 30 years on a monthly basis. That's being said, we're gonna make you a millionaire. That's being said, also, my name is Mo. I have over 10,000 hours in the live market trading, tested over 100 plus strategies, build my own tools and dashboard. Today, we will be watching Portfolio Visualizer over here and we will be digging deep into it. So I was experimenting a little bit with it to figure out what is the best risk adjusted return in terms of getting your ATF at the same time, how not to ruin your life. Just not allocating everything in S&P 500, and what does it mean for us? We all of now know the S&P 500, the SPY, but none of us know the RSP. So equal weighted S&P 500, right? So majority of people don't realize there is S&P 400, there is S&P 600, etc., right? So they always focus on only one side of the information. And the most important thing, this is not financial advice. Do your own research. And if you want to invest, seek your own financial advisor. Everything is here is my own opinion and it's not meant to take it as financial advice and do it exactly as it is. But the education is very important. And that being said, let's do and construct our own portfolio over here. The first thing we want to do, we go to portfoliovisualizer.com and we add a couple of data over here. You can add couple of data and even choose a preset of portfolios, right? So when you go to Portfolio Visualizer, you go to Tools and you choose Backtest Asset Class Allocation, then you can see how your portfolio would have performed in the past. So there is different strategy, etc. Let's you can choose even or you can construct it yourself on the left sides if it's gonna be large cap, mid caps, treasury bonds, etc., gold, and real estate, ETF, commodity, or something else. You can add it over here and you can backtest it and you can backtest a couple of strategy. This is one of key important thing majority, 90% of retail trader doesn't do when it's coming overall backtesting at strategy, right? So they go into the market with a hopium in the blood and wish it works the best based on a feeling, which based on illusion. That's being said, I have added over here one of my portfolio total market of the bonds added 10% because I'm a young guy. I don't want to have everything concentrated in bond, which is a safer way to earn money, right? But have less ROI in comparison to stock market. And when we watch the efficient frontier, we see on this efficient frontier over here couple of things, right? When we zoom in, over here the efficient frontier is telling us where each asset is specifically aligned, right? So when we go to pictures, maybe we can find something which is telling us a little bit more. So basically said where the bond market is, which strategy where it are. So the higher on the right sides on the top it is, the higher the ROI, the higher risk you take, right? So majority of the time the bond market is going to be over here, right? So the bond market is going to be over here and stock market somewhere here, right? Maybe real estate here and maybe single stocks over here. So that's being said, you need to understand the efficient frontier theory. What does it mean and what does it tell you? It doesn't necessarily you need to be a proficient in it, just understand and which risk metrics you are targeting. If you are targeting 20% ROI in the market, then you need to be able also to take a risk of 10-15%. So you cannot do the ROI without taking the risk, right? So that's what efficient frontier basically is telling us. So over here, I have added 10% into the bond market, 5% into real estate, 45 in large cap because large cap for me has the highest return in base and trading metrics. So the highest return for the lowest risk in comparison, which we call it risk adjusted return or a Sharpe ratio in a professional level. That's being said, Additionally, I have added a 20% in the emerging market, so such as India, Africa, etc., Middle East, and 20% in gold to protect myself against when the market is very unsure, which is in the current condition. When the Fed cuts rates, the market's unsure, the stock market unsure, the volatility in the bond market, gold tends to go higher. If you don't want to construct it yourself, you can choose a model which is already uploaded. For example, a lazy model, right? By stock 60% and 40% bond, or you can choose something else over here. Anyone you think is pretty fair difference. So you need to figure out which risk you want to take, what are you willing to get, right, in terms of those risks. And also we can add the Ray Dalio. So portfolio number one is my own. Second portfolio is 60/40 by bond and stock. The third one is the portfolio of Ray Dalio seasons, right? So we what we're gonna do additionally, we go to the settings over here, and the settings I have chosen 1995 because the data is goes back to there till now, so 30 years. If you are in your 30 and you want to retire by 60, it's I think a good measurement. And I was like, okay, and want everyone to be able to be investing, right? So let's add only with initial $1,000 in it, and 450 monthly, a fixed amount of contribution monthly cash flow to the ETF, right, to your portfolio. So at the end of the year, you have around 500 something in it. Yearly, you're adding additional 5,000 into your portfolio. That's being said, it's very important to understand that. So let's we continue with another metrics over here is inflation adjusted, right? So it's basically it's telling us when you go to the icon over here, it says adjust the contribution to the inflation, right? So it doesn't matter what the inflation do, is always going to be 450, and you're adding a little bit more to it. So when inflation is high, you make it 480 or something based on the years is going by and the inflation you are having. And the contribution amount, is it going to be monthly, quarterly, or annually? And balancing, rebalancing, is it going to be annually? So we want to adjust our portfolio, the weight of it. So we given those percentage over here, right? So we given this percentage, and each time sometimes assets such as large caps is moves higher, and you want to take that money and put into the other assets. So you have always 45% in larger cap and 5% always in real estate and 10% always in the bonds market, right? Which one is it tends to perform much better? You take that money and you put it and distribute it between all other assets. So basically, that's what our rebalancing annually is doing. So are we going to use leverage? We're going to use no leverage. And let's analyze our portfolio over here. When we click analyze, we can see different pie charts on the right side and also on the left side, each percentage of each asset. So totally we have over here 100% my strategy, which is called Mark Faber because I used that before that. 10% is in bond market, 5% in real estate, 45% in large caps, and 20% in emerging market, and 20% in gold. Majority of people mistake gold is a hedging mechanism against volatility, right? So volatility means when the markets go up and downs or down. So that's for that reason they are buying gold because it's safer, safe havens, right? They buy bonds, golds, silver, platinum, etc. But it is not true. Only when actually the worry in the market is, the gold tends to be performing well. So keep in the mind, gold is not automatically a hedging mechanism against volatility. That being said, let's go deeper into our analysis over here. We want to have two metrics, best years, okay? So we want to have those best years comparing it to the worst years, right? And we want to have the best years above the worst years, right? So we have chosen benchmark, the Vanguard 500, so S&P 500. So the worst year for S&P 500 in that period was 37%, right? Or 37% in 1 year, or you can watch the drawdown, which means from the pivot point, the highest point to the lowest point, it was 50% without the cash flow, right? So you should expect that drawdown. So if you cannot handle S&P 500 going 50%, right? If you have a 100,000 in S&P 500, it means you left with, if you sold it, you will be left with 50,000. That's basically saying. So we want to watch the best years in comparison to the worst years. So we can draw it over here, right? So let me see if we can draw it. We want this matrix, we want this matrix, and we want to have the Sharpe ratio also. The Sharpe ratio is telling us for the dollar risk we are taking in comparison to the return we are making. So the higher the Sharpe ratio, such as 2 or 3, it is great. This means we are making more money than the risk we are taking in the markets, right? So that's being said, the Sharpe ratio of them seems to be very similar. Only the stock bonds tends to be higher over here. For what reason? Because we have more weight in the stock itself in comparison to other strategies. And second thing is we see one thing is only the S&P 500 tends to be doing worse than the best years. So all strategy seems to be doing well, and the best strategy is performing is my own strategy, which is in comparison to the worst years, and the best years has the biggest difference. And let's visualize it a little bit, right? Let's take it a little bit visualization. Upstairs, we see the S&P 500, right? So that line over here, right? This is S&P 500, SP, right? And the blue line is mine, and this turquoise line is the bond strategy, and one strategy is missing. I would assume this is the Ray Dalio strategy. So the Ray Dalio strategies tends to be not the best in our case. But how much ROI we are expecting of our initial 1,000 investment and $400 $450 monthly contribution. So how much are we expecting? So if you looked over here, right, S&P 500 has done 350,000 in the last 30 years. So our ROI is going to be 350,000. And if we added also the bond markets, the stock bond markets, so some mistake over here. I don't think. Okay, the S&P 500. So the S&P 500 is 500,000. Our strategy or my strategy is 350,000, and the bond and stock 60/40 strategy has 312,000, and Ray Dalio all season 200. So the worst performed one is this Ray Dalio based on the past historical data, right? And the best performing is S&P 500 by a huge gap. My strategy done as 350,000 and S&P 500 510,000. That's being said, keep that in mind is very important. So we want to adjust it for inflation because inflation happens over times and you have a more realistic data. So the S&P 500 would have done 300 and my strategy would have done 220, which is a huge gap and tends to be getting wider over time. That's being said, let's check out if the recording is still going. Is perfect. Additionally, we want to watch a couple of data over here. So over annualized return over here, we want to watch this section, the 10 years at least, right? So we want to watch this section 10 years and the most important one over the fall period, right? So my strategy has done as 9% ROI and the S&P 500 has done 10% 0.6 ROI, right? So we want to focus on those two over here, and this one approximately both of them are very near to each other. So that's being said, they are similar but huge gap. If you tends to like to take more risk, S&P 500 could be better for you. But if you tends a little bit less risk and more distribution and diversification, which is much better in terms if a one market goes down, the other markets tend to go down a little bit less, right? You don't take the full hit. All this data of annualized active return is good to know, but right now we will be skipping it. And we want to watch one thing over here: benchmark versus our return. So our benchmark tends to be making more, the S&P 500, as we said, which was logical. But when we look at drawdowns in terms what's happening over here, our drawdowns, my own strategy tends to have lower drawdowns than S&P 500 by a third approximately, right? So we are taking a third less risk in comparison to others, right? Actually, this is ROI versus down markets, right? So up market versus down markets, our strategy tends to be taking less hit. That's being said, let's move on to other strategies. The bond and stock market strategy tends to be also doing similar, even a little bit better than my strategy when it's coming to taking less hit in the down markets, but also leaving a ton of money on the table when it's coming to the up market rates. That's why bonds tends to be holding back the returns in the up markets. In the down market, they are great, etc. In Europe, in Austria specifically, where I'm located, you cannot do it by rebalancing your portfolio in terms selling a stock. When you sell a stock or an ETF, you are obligated to pay taxes, and those taxes are could be 27.5% in Austria, right? So always check out in which jurisdiction you are. If you are in America, England, Australia, leave a comment down below and tell me how much taxes you pay and capital gains. One thing we want to watch the worst, which I have done the Ray Dalio strategy, which has much wider performance, right? When it's coming to down markets, it tends to be very much more stable in comparison to other street strategies. But when it's coming to up markets, it tends to also be very bad. So it is not the best strategy. It's leaving the most amount of money on the table over here, right? So we said Sharpe ratio is good, Sortino ratio is good. Gain loss ratio is also important. So my strategy over here, in comparison, 62% of the time the market goes up out of 227. This is telling us we are making more money on the upside than the downsides in terms gainers losers days, right? So I think that was one key metric we want to tell over here. And the second thing is watching the correlations. Watch the correlation in the markets in terms of which assets are very correlated to each other, because you don't want to have asset which is correlated, because one asset, if it goes down, the second asset would follow because they are correlated. Correlation is not causation, so it's not causing what is happening, but they are correlated. This means when asset goes down, the second asset goes down. You always want to look for bond markets and commodity markets, for example, right? Bond markets and commodity markets tends to have a little bit negative correlation, which is good. If you have your money in the bond market, right, and you have commodity markets, one asset go up, the other asset go down, right? So it's two tends to be more risk adjusted return, which we talked about, right? So we want to have less volatility but higher ROI in terms. That being said, let's dive into the second metrics we want to check over here is the portfolio, right? I think, let me figure out over here. Where was it? So it was basically Monte Carlo strategy, right? So you can go to the tools over here to go to Monte Carlo simulation. You click on it, you put the data again, right? Or you can choose one of them. Let's choose the 60/40 strategy, right? Your initial was 1,000, right? Fixed amount contribution, we said 450, and inflation adjusted, yes, Simulation period, we said it's going to be 35 years. No, it was exactly 30 years. That was okay. Tax treatment, pre-tax return, simulation model, historical return is okay. And useful history is also okay. Single years is okay. Sequence of risk adjusted rebalance annually is okay. Let's calculate the Monte Carlo simulation. Is going to tell us again and choose us the best strategy in the best case and in the worst case, right? So it's telling us if we took the bond and equity strategy 60/40, it's going to tell us in the best case scenario we're going to be left with 55,000. In the worst case scenario it's going to be 55,000. In the best case scenario it's going to be 160,000, right? So it's just always you want to watch that, okay, which expectation I have, because at the end of the day it just could be those ETF portfolio which you have for retirement or you want to give it to your child, is which is we call it in the professional level wealth transformation, right? You take the money and give it to your children, and majority of times in many countries is tax obligated, but there is a strategies and ways to avoid this tax optimization. We call it tax optimization and not tax avoidance. Tax avoidance is illegal and tax optimization is legal. And second thing you want to do also, always check the inflation adjusted, because it's going to give you more realistic data. As we see, it tends to be much lower in terms of the buying power. Inflation adjusted is telling us how much buying power this money has, right? So that's being said, we want to also check out the balance. So the balance how it is tends to be, and in the base case scenario, etc. And we also want to check the max drawdown how it is tends to be, right? So majority of time we do a bell curve, right, to figure out how the distribution is and check out the the tails over here. So we see a maximum of drawdowns of 42%, right? And also many times we see over here it tends to be in the middle with cortosis. Over here we call it cortosis, tends to be higher, right? So majority of time we should expect over here in this range of drawdowns between 26 to 21% drawdown. So the simulation is just telling you again. And that's being said, thank you very much for watching this video. Don't forget, if you liked this video, leave a comment, leave a share, tell our friends, and always be careful out there. Don't invest your money if you don't know what you're doing. Seek financial advisor. And the most important things, I'm not giving financial advice over here. And it's my own experiment and my own assets. Go to Portfolio Visualizer, test it yourself, and tell me which result you got and which strategy worked the best for you. And if we reach 10 plus likes, I will do a new video about the subjects, how to construct your own ETF portfolio for your retirements, your ROI against inflation, etc. See you then.